A consensus is emerging around the situation in the Middle East that the worst is behind us, that the resolution to the conflict and an outbreak of peace is not far away. And although not many commentators have been able to describe a credible path to that point, markets are pricing exactly that. And so the rally back that we saw yesterday in the Asia-Pacific region meant that we followed the US leads, and US markets were flat in overnight trading. In other words, they're waiting for the next development. And whether we look at the S&P 500 or the NASDAQ, it was a very flat result. Of course, here in the Asia-Pacific region, we played catch-up yesterday. The ASX 200 up by 1%, the Hang Seng up by 2.2%. But futures indicating that the positive momentum that we saw in trading yesterday is likely to continue at the open this morning. Whether or not we'll end the session that way will depend very much on news flow. There are conflicting reports about the current state of play in the Straits of Hormuz and whether or not there is passage available for oil tankers. But overall, the fall that we've seen in the oil price and the bounce back that we've seen in share prices indicates the markets are confident that the Straits of Hormuz will soon be reopened. Now, that was reflected in overnight trading in individual stocks as well. Micron up 3.5%. Palantir, which had risen on anticipation of an increase in the conflict, fell away as its piece seemed more likely, down 3.5% or thereabouts. DroneShield, though, bucked the trend. It was up 8.4% in trading yesterday, bouncing back, one of the most volatile stocks listed on the ASX at the moment. No surprises with that daily return. On the other hand, that big fall in energy prices saw pressure on the oil and gas stocks, Woodside in particular, down 3.8% in trading yesterday, despite the gains in the broader market. So the oil price holding around $87 at the moment, gold around 5,200. So we're we're certainly at more elevated levels, but we've pulled back from those extreme highs. Bitcoin has recovered somewhat and is fluctuating around the 70,000 US dollar mark. However, the VIX, the volatility index in the US, indicates that fear is still elevated. It's sitting a little lower than it was yesterday, but still at 25, above the fear and greed dividing line at 20%. So still some concerns being expressed in the options market about the outlook for US shares. On macro news, we'll see the US CPI out tonight, 2.5%, the considered core and headline reading level. Now, anything away from that level is likely to spark a reaction, one to watch tonight. It could change things. We're also seeing an increasing consensus that there will be a rate hike next week in Australia. Now, this is a change in thinking. Just 1 week ago, even after the outbreak of the conflict in the Middle East, markets are pricing just a 1/5 chance of a rate rise at the meeting next week. However, the situation and the deterioration in the global outlook and the increases in inflation that we've seen as a result of the blockading of the oil market has more and more analysts expecting a rate hike next week. And in fact, interest rate markets are now pricing a better than 50% chance. And one of the global investment banks came out yesterday and called for a rate hike next week. So how the market will react is as yet unknown. It's certainly no surprise that rates are going up in Australia. That has been consensus for some time. However, in March is a little earlier than many were expecting. We might see some pressure on shares as that eventuality is priced into the market today. But we'd also like to take a bit of a deep dive into the Australian earnings reporting season. We've had reports from 188 of the companies listed in the Australia 200 index. And there have been a number of pretty clear implications for investors and traders out of the results that we've seen. The biggest picture, or perhaps the biggest takeaway, was that we saw increased volatility in individual stocks in response to their earnings. Now, there are a lot of theories about why this is so. The advent or the increase in algorithmic trading and momentum-based strategies that come with that algorithmic trading does suggest that we're seeing some exacerbation of the moves in response to earnings reports. There's also been a case made that the steamrolling of the value investing style by the index investors has meant that there are simply less people willing to buy a stock based on their view of where the share price should be. And that means that when a stock is hit hard in response to a poor earnings report, there's no value buyers sitting below at a price willing to take it on. So perhaps both of those phenomena have contributed to the situation, but nonetheless, it's easily observable. But that this reporting season, we saw more extreme reactions to reports than I think I've ever seen before in the Australian market. But the implications were fascinating. Tech was sorted out into AI winners and losers. So WiseTech up 9% in February performance, Nuix up 13%. Because both of these demonstrated with their results that they're using AI to advance their businesses. However, a lot of software stocks were hit hard in response to the advent of artificial intelligence and their results illustrating those impacts. Life 360, one of the examples there, down 19% after it reported some impacts from AI on its revenue line. Consumers were divided. We saw the lipstick effect in play. Consumer discretionary spending has plummeted, and the results and the revenues that we saw in that space were reflected that, whereas consumer spending was up. And you might recall one of the features of the reporting season was Woolworth's 16% lift in revenues, and that's very unusual in a stable business like the supermarkets. Its shares are up 7% in response to that, in contrast to Temple & Webster, which is down 27.5% after its result, given and after Temple & Webster were forced to report slowing growth in their order books and a big drop in their net profit. Another theme that emerged over the reporting season here in Australia was the gold and copper miners who did so well out of those elevated prices. Copper trading near all-time highs, gold doing the same thing, and that dropped straight through to the bottom line of a number of the miners. Evolution's up 10% in February after reporting, and other gold miners like Northern Star up 8% for February after reporting. They both hit record share prices, the highest trading ever in both of those key gold miners. BHP, also a beneficiary of this thematic, up 12% in February after reporting. Its copper focus has really paid off, and the big lift there across the board, including in the revenue, in the dividend, a 46% lift in dividend, pleasing many shareholders of BHP. Other themes that came out of it, legacy finance continues to win. The big four banks continue to dominate the space. Three of the big four, Westpac, ANZ and NAB, all hit record highs for their share prices after reporting. CBA reports on a different cycle and has a slightly different share price outlook, but nonetheless, it did appear they are the big winners in the finance space. This is in contrast to some of the smaller players and some of the newer players, and in particular, buy now, pay later stocks came under pressure. Zip down 22%. AMP also, after disappointing the market, once again, a perennial disappointer, AMP down 17%. So finance clearly dividing between the big four and the rest. And it just reiterates that point. Some of those falls that we saw were very distressing for shareholders. Now, it was interesting to note that over the reporting season, 50% of companies fell on reporting day. That's in contrast to the US, where 80% of reporters beat. And so that mixed bag of reporting for the Australian share market actually ended up a slight negative for us, because the fallers were hit harder than the good reporters were lifted. And those big falls were concentrated. So the biggest moves, the five biggest moves, all more than 20% in response on the day of their earnings report, were all negative. Austal, one of the examples there, the literal destroyer class shipbuilder, down more than 20% after its report. And the healthcare sector illustrated this very well. Health, CSL and Cochlear both disappointing, down 7 and 17% respectively after reporting. Pro Medicus was also down around 8.5%. Whereas in contrast, Ramsay, which had been under severe pressure and whose share price had more than halved since September last year, reported a better than expected outlook and jumped by 12%. So illustrating exactly what we're talking about there, that the market reactions to earnings reports are getting more dramatic, which means that for investors, it's always important, but it's especially important now to understand when the stocks you hold are reporting and being aware of the potential for big market moves on that day. A quick look at our watch list for today. Liontown is on it because it's one of the last two report. As I said, only 188 of the 200 have reported. Liontown will report tomorrow. Now, in anticipation of this report, we've seen some strong moves, and Liontown yesterday was up 5.3%. So obviously some expectations here that the lithium bounce back will show up on the bottom line for Liontown. Stock is up more than 150% in 12 months. So it's trading at an elevated level, but it's down almost 30% from the high that we saw in January. So there's been some moderation of that enthusiasm, possibly positioning it for a positive response to its report tomorrow morning. There have been some board changes and some major shareholder shuffling. A lot of analysts have a hold rating because of the uncertainty around the outlook for lithium, but nonetheless one that a lot of investors are running their ruler over. Oracle has reported this morning in the US. It's up more than 8% in aftermarket trading. It's certainly beat on quarterly expectations, and cloud revenue up 84% was one of the features of their report this morning. The full year guidance is above expectations, but perhaps more importantly for the trading in Oracle shares, it reported it has no more fundraising to do to fund its artificial intelligence initiatives, and that its AI cloud demand is running much faster than supply. In the Moomoo community, there's a strong buy rating on Oracle, certainly one that's drawing attention after reporting its result this morning. And the last security on our watch list today is an ETF. This morning, looking at the USO is the code. It's an oil ETF listed on the US exchange that tracks the price of spot crude oil in the US. So it's up 20% in 5 days, but it has been up significantly further, remembering the volatility that we've seen in the oil market, especially on Monday morning this week. But the USO oil ETF is up 55% year to date, reflecting that recovery in crude oil prices. There is strong buying pressure around this, and it does seem to be trading now at a slight premium to the spot price. It also made the most traded list for the Moomoo community, and so it's clearly popular with shorter term interests. It is created to mimic the daily moves, not the overall long-term moves, but the daily moves in crude oil prices. And it's an example of using tactical trading. When market conditions change suddenly, or there is a dramatic change in a particular market, there is an opportunity to take exposure to that tactically via these sort of thematic ETFs. USO, one of the most popularly traded on the Moomoo platform this week.